Richa, what is the overall investment process you follow to take a client through their wealth management journey?
We have a very, very detailed investment policy document that we execute with the family. So it's a very detailed document that we sit with the family, all family members, wherein we capture a lot of the information about the family's assets, about what their objective is, about what their risk tolerance limits are, and all of the what their time horizon is, what are they looking for. We then put that into, so we have a detailed process wherein through which we understand what we articulate, and we come down to an investment policy document which articulates really what the family wants to do, what they don't want to do, what are the constraints and what they want to do. Taking that from that point of view, we then look at what are the asset classes available in the Indian context, because there are various asset classes that are not available to be invested in the Indian context.
Richa, what's your specific approach towards asset allocation?
We look at 4 different blocks. So we look at the macroeconomic environment, we look at the asset class performance, historical, we look at what forward-looking variables there could be to that, what are the macroeconomic environment factors that will affect the performance of these asset classes. We look at third-party research. We have an access to a large pool of third-party research, which we also take as an input. We have our own in-house team that has an asset allocation view on each asset classes. The 4 of them together basically give us a view on each asset class. Once a view on asset class is decided, we then use both qualitative and quantitative tools in determining what the asset allocation to be. So while we use all technical tools like these, efficient frontier analysis and all of those things, but we also superimpose on that the qualitative judgment, because we recognize and we realize that all of the technical tools that you can employ in any asset allocation exercise have the trappings of using historical information as a starting point. So we do tweak the forward-looking variables, and then we decide what the asset allocation would be for the families.
Do you have any examples of how you provide tactical advice for clients?
Every 6 months, or when market changes when market variables become very, very dynamic, we stress test the portfolios. So for example, towards the end of last year, around November, we stress tested our family portfolios and we made all our families go underweight on equities. Since the beginning of the year, our biggest concerns were that interest rates in India were rising, inflation was a big concern, there was big global uncertainty. We put all our families into long duration fixed income instruments. So we are very dynamic in the way we are managing the asset allocation of the family. So it's not that if somebody's equity and fixed income, that's what it remains in cast in stone. We do underweight, overweight, within the overweight, within the fixed income pot. It's not about allocating across, it's about taking very, very concrete duration calls, and then within those duration calls identifying the products, the managers that are adhering to those duration calls.
Richa, how do you help manage the expectations of clients from the investment returns in financial assets, given the returns they're likely to be making from their businesses, probably in the region of 25% or higher?
One of the biggest challenges or questions we face when we look after family business owners is that they say, look, my own business is giving me a return of, like you said, 25-30%, 25%. Why should I be looking at investing anything which is giving me less than that? So the idea that we always speak to our families is about diversification, about creating a nesting egg, which is dealing to their core business activity, because right now whatever they're earning from their business is inherently linked to that business and that business cycle and that business and whatever that business would do. So the idea is not about, when you're creating a nesting egg or a portfolio which is not directly correlated to whatever you're doing in your business, it's about creating a return which is not probably competing with the return you're making in your business, but it's about diversification and diversifying out of what you're primarily exposed to, which is returns coming from your business. So even though the families are investing, so even at 100 crores or something, when a family is giving a portfolio to us, their net worth is in excess of thousands of crores. So still a large part of their income or their returns are coming from their family businesses.
Richa, given the limited product range available in the Indian market, what can advisors do to add value?
Like you rightly said, the product universe is very, very standardized, and there's very limited you can do in what is generally available outside. There's equity mutual funds, there are fixed income mutual funds, there's structured products, and a little bit on the fringe around that. I think where families think that an advisor can really add value is if they're able to source for them unique investment opportunities. So these could be either by identifying businesses that they can invest in, identifying structured investment options for them which are not otherwise largely available or marketed in the universe. So it could be maybe structuring a debt or a return for them which is collateralized by assets which are put into a trust, which are with a trustee, and that can give them a return of between 16 and 18%, something like that. Or identifying businesses where they can get a consistent return. So it's identifying unique investment opportunities for families where their return can be far in excess of what is otherwise available from the universe, that is.
So why would wealthy individuals look to do anything other than leave their money in cash, given the returns they can get from bank deposits?
It's all relative, right? So if you ask somebody in London who's getting 1%, 2% in his bank deposit, he'll say, if I'm getting 10% in a bank deposit, I'm very happy, right? Because inflation is 2, 3, 4%. In India, where inflation is 10%, if you're getting 10% in a bank deposit, you're getting nothing effectively. So to be able to get anything over inflation, you're looking at a much higher return hurdle than a bank deposit. And that's why you have, and so typically, historically, for the last 5 years, equity markets in India have given a return of 15% above. Structured debt has given anywhere in the range of 13 to 14%. So in India, people are not looking at getting returns which are much higher than the inflation, because that's where the real return is coming. At a real level, they're still making only 5-6% return.
So what due diligence do you do on managers and other product manufacturers?
In terms of product selection itself, we have a very detailed qualitative and quantitative criteria in selecting the product, the recommended universe of products. So quantitative criteria is very much like any large quantitative organization may be deploying, which is looking a whole host of 25 variables, from various period returns to a downside risk to historical. But our qualitative research is very, very deep. So we spend a lot of time with managers understanding their risk management process, what is their investment decision making process, what is their stream structure like, what is their strategy. We do a lot of back testing of their strategy to ensure that what they have told us is in alignment with what they have shown in return, because often we find great disconnect between what a manager says is their strategy versus what actually, when you do the attribution analysis of the product, you find that the returns are not coming from the source they have said that they derive their return from. So each of the product, we do a lot of contribution, attribution analysis of the historical returns of the product. Even when we are taking a product on board, so let's say we have a new PMS manager that's coming on board, we have an observational period of 6 months wherein we require the manager to give us detailed information, we analyze, and we have a period of observation, analysis, and if we see the consistency of performance of that manager, and then that, that product gets recommended.